PSG Asset Management has more than 15 billion rand under management, according to Greg Hopkins, global head of equities at PSG. And investment philosophy is an important ingredient for giving direction to any asset management firm. I caught up with him and we unpacked the group's investment philosophy.
A lot of investors in asset management companies don't focus on companies' philosophies as much as we think they should do. My colleague actually wrote a very good piece this week about investment philosophies and how important they actually are. And he likened it to almost as a non-executive board of directors that gives very, very clear direction for the asset management firm, but it doesn't stipulate in terms of exactly how you must run your business. So for us, we distill it down into 3 words, and we call it the consistency, conservative, and contrarian.
So consistency, conservative, and contrarian.
Consistency as in the way that we actually run our investment process, that we're consistent in terms of what we've done over the last 10 years, we will do in the next 10 years. Conservative in terms of how we actually value and appraise the companies that we operate in, that we actually invest in, and contrarian, that's the tough one, and that's the one that in this sort of environment that we're investing in at the moment, that's the part of the philosophy that actually instills courage and guts.
You need courage in current markets. Just looking
Absolutely.
at the volatility we're seeing at the moment, so much uncertainty out there, and it's clearly a risk-off trade. But you do ignore the noise, and we hear that from a lot of fund managers. But that must be tough when the noise is so very loud.
And that's why philosophy is so important. Go back to your 3 C's. Stick to your process. Ignore the noise. Look for the long term. You know, for instance, at the moment, a lot of the economic data, a lot of the, there's a lot of negative news flow out there. And one needs to remember that companies, in terms of valuation, is the present value of future cash flows over the life of the company, not just over the next year or 2 years. So one has to look for the long term and invest accordingly.
Does the team stand together to make sure that you all manage to stand by that philosophy? Because sometimes there could be a little weakening here and there, thinking, listen, the noise, as I said, is a crescendo.
And I think that's actually a great question. And how a team interacts with each other is what is actually called the investment culture. It's how the team actually can sit around a table and reach the right investment decisions and right investment conclusions. How they actually apply the process that has led to the track record in the past. And in times like this, it's important to stick to your process. And it's important to have different opinions around the table. So different investors or different teammates will have different opinions, but it's very important that you stick to your process. You play the ball and not the man, so you can actually make, the discussions you have could be quite spirited, but they're all focused back to your process and how you look
all
at
right,
things.
now let's talk about your positions at the moment. You are head of global equities, and we are seeing a theme unfold where a number of fund managers are saying that there are developed world equities that are very attractively priced right now.
Yeah.
Where do we start with that?
We would tend to agree with that. If you actually take a step back and we look at global equity, South Africa is actually included in the global equity universe for ourselves. And we typically like to look at things from a bottom-up point of view, so we'll compare South Africa versus offshore equities. Our investment team is arranged in such a way that our team is ambivalent whether they look at domestic companies or offshore companies. So we compare and contrast on a cross-sectional basis. At the moment, we're finding less value in South Africa. We're still finding some great opportunities in the mid-cap space. We're finding, on balance, few opportunities in South Africa. And then we look abroad and we look offshore. There's a lot of stress. There's a lot of
there's trouble afoot.
Which typically in Europe and in the US as well. I think there's a lot of stress about and a lot of fear about where the US economy is going to go.
Absolutely, in light of the recent jobs data.
Absolutely, which creates opportunities. If you compare and contrast, say for instance, emerging equities versus developed market equities, I think there's been some interesting lessons over the last couple of years, which has highlighted some of the difficulties about investing in emerging equities. If you're going into places like China, India, Brazil.
Do you mean just unpack that for the audience? That means that you deem China is an appropriate place to invest, and you try and invest in local stocks. Is that what we're talking about here?
Absolutely, absolutely. So if you're a global investor, you have the opportunity investing in China. Typically not in China directly. You go through Hong Kong, Chinese listed companies that are operating in China. Hong Kong listed companies that are operating in China, or Indian companies, for instance. But if you're investing in these type of markets, typically the attractions are growth, and you get visible growth in places like China. You can just look at the GDP growth over the last sort of 10 years. But often you're making a trade-off between growth and corporate governance. You know less about the companies that you're investing in because things are just a lot more opaque, especially as you go into countries like China, Indonesia, and India. And there's
so
always
would
this
you
trade-off.
advise investors against trying to get direct access to those markets via local stocks simply because of the corporate governance issue? Not
necessarily, but you've got to do more homework. I think the hurdle rate in terms of the duty of care and due diligence, the process of discovery, which we call discovery in terms of understanding the underlying investments, is a lot harder in a place like China than it is in the US.
All right, now let's talk about an interesting stock, because perhaps you can get that exposure through a stock like Naspers. Yes. So you get your emerging market exposure through a stock that doesn't necessarily operate totally out of the territory.
Yeah, and I think Naspers is a good example. It's still a South African listed stock, but yeah, it's got a very diverse earnings stream, and Naspers is an interesting one because it's playing in the global environment. There's this element of optionality in a company, investing in a company like Naspers.
Unpack optionality for me.
A company like Tencent was started a number of years ago, but it's mushroomed, ballooned into this amazing sort of opportunity. And Naspers has got a history of developing these type of ventures, and the type of environment they're operating in, the media space, lends itself to these sort of businesses that are very, very scalable, and you can actually get from no customers up to almost 1 billion customers in the face of Facebook in a very short space of time.
Taking into account that optionality, then, do you like Naspers at current valuations?
We don't own it across our funds. It's not on our buy list. We have in the past. We think that the margin of safety is less prevalent. Maybe you can just take a step back. When we talk about equities, we typically will refer to what we call our 3 M's, and that's our investment process, and it guides pretty much everything that we do. We look for strong businesses, moats, strong management teams. That's the management part, the M, the second M, and then margin of safety. If you look at Naspers, we think the moats are pretty strong, especially in the domestic pay TV
You're talking
business.
about like barriers to entry. That's basically your moat.
Yeah, that's part of it. Yeah, it's if you look at a lot of people talk about barriers to entry, but often don't spend enough time thinking about what actually derives and what drives a barrier to entry or a moat. And
all right, I'm going to throw something at you. I was speaking to Nick Norman-Smith recently, and he said, we were talking about the retail sector.
Yes.
And he was saying that there is no barrier to entry in the retail sector. Look at Walmart coming in, etc., etc. Do you believe that that's the reality? There's no barrier to entry in retail?
No. I think the fact that Walmart had to buy a business that was already in existence suggested that it was very difficult for them to actually enter the industry. They couldn't do it on an organic basis. And there's a lot of intangible, there's a lot of tangible in terms of the actual stores and what have you in the retail space, but there's a lot of intangible that attracts customers to that brand or that retail store. And the intangible part is often more difficult to measure, but the fact that Walmart had to pay so much money and at such a high price to come and enter this industry for future growth, I guess, through Africa, but also to buy a footprint, suggested to us that it's actually there are some significant barriers to entry.
Give me an example of a company or a couple of companies that have strong moats, in your opinion.
Yeah, sure. If we actually just look at the concept of a moat, we can unpack it into basically, we think there are 4 criteria that actually make up a moat. One is in terms of you need a cost advantage, which we often call the supply advantage. So, for instance, if you're in the mining space and you're selling a commodity, you need to be at the low end of the cost curve. If you're producing iron ore out of the ground at $20 a ton and it's selling at $150 a ton, and your peers are doing it at much higher rates, you've got a big advantage. And if you're a steel company, for instance, like ArcelorMittal, that actually has an integrated sort of mining supply, it actually makes its own or produces its own iron ore, and it's got deep water ports close to where the iron ore is, you've got
very solid moat.
That's a reasonable moat. It's actually the weakest form of moat because you're still selling a commodity, and that, you know, as those ore bodies deplete, you have to reinvent yourself. So that would be the simplest form of a moat. The next type of moat that we often look at and refer to is one through government license or patent. So, for instance, the pharmaceutical company, I'll give you an example, Pfizer. Lipitor is a very, very big drug. It recently went off patent. Now, that's almost a $100 billion drug over the last sort of 10 years. It's phenomenal at very, very high gross margins, almost 70–80%, and it cost $1.5 billion to make. It's a phenomenal sort of payback. But 3 months after that drug went off patent, the sales went from 11 billion a year to 2 to 3 billion a year. So it kind of gives you a sense that very, very strong moat while it lasts, and then it disappears.
So you need to be sure of the viability or the sustainability of that moat,
yes,
if you're going to invest in a stock on
absolutely.
on it.
But, you know, for instance, the pharmaceutical company is a very strange animal that every 10 to 15 years it has to reinvent its whole business. But it's very profitable while it does that, and it's got a big R&D sort of, you know, that it spends a lot of money on R&D to actually grow that business in the future.
We're running out of time,
sure,
but we need to also just touch on your management aspect. So give me one stock that you deem to, and of course you look at all three of these in tandem, so you're not just investing on management, but a stock that meets that criteria along with moat and margin.
In the global space,
we
think Unilever is a fantastic management team. In fact, it's one of the best management teams out there, and it's quite actually something when you know, when we go to bed at night or we, you know, spend time with our families over the weekends, you know that there's a company out there that's actually working around the clock on your behalf, and we think that's the kind of the ethos that encompasses a management team such as the one at Unilever. Unilever was a dog in the sector for the last 10 years. It's traded at a big discount to its peers because it had lost its way. And this is what happens when you get these sort of businesses with high quality assets, very good market positions. New management team comes in, reinvigorates the business. And, you know, then we think that the next sort of 10 years is going to be a lot brighter than the last 10 years, which kind of lends that second M in terms of what a management team is up to.
And then let's touch briefly on margin.
Margin of safety is the most relevant for us, and that's the middle C of our, you know, our 3 C's in terms of our philosophy, being conservative. You need to invest in companies or investments where there's a large margin of safety. You're buying at a discount to the intrinsic value. We get things wrong. We always get things wrong. In fact, we look for a 60% hit rate in terms of getting things right. The 40% you get wrong, you need to get your money back at the end of the day.